In the name of God, the most merciful, the most beneficent. As we are continuing for CMA Part 2, Chapter B and Section 2, Corporate Finance, and in this part of this lecture, we will be covering about valuation of equity capital, that is including common stock and preferred stock. So ICMA Learning Outcome that this part of this lecture will cover is about value of common stock and preferred stock using discounted cash flow methods. In summary level, we can understand that valuation of shares, we will have to study, we will have to understand what involved, like use of judgment, experience, knowledge of the analyst, that one attempting to valuation of shares, and his technical skills including analysis and interpretation of financial statements and all others. And then what are the approaches that we have: income approach, market approach, net assets value approach, and purpose of valuation of shares, because based on the purpose, on what purpose, then the approaches might change also, because sometimes combination of all the approaches will be useful for certain complicated situations. So that all we will have to study in detail one by one. So common stock valuation requires careful projection of future growth and future dividends. So only by carefully calculating the future growth, estimating the future growth and future dividends that one will receive, which are largely determined by annual dividends, dividend growth and discount rates. So what is the usual annual dividend that we are getting, and what is the trend it is going, how the dividend growth is happening in the market, and the discount rate, what is the market discount interest discount rates are going on. So accordingly, then only we can judge the common stock valuation. It involves use of judgment, experience and knowledge of the analyst or the financial manager. Analysis and interpretation of financial statements backed by practical appreciation of business affairs and investments. So this is very important, because just only by reading the financial statements alone, you cannot have a proper judgment. You need to appreciate how the market is going on, that what are the market, what are the business affairs, and how the economy is going on. So all these things has to be thoroughly studied. And appropriate method of valuation of shares also need to be studied, understood, and practically experienced for that. The purpose is very important. Then only we can see what are the complications involved in valuation of a stock. Accordingly, what method is more appropriate to that situation. So therefore, it is very important that we should understand the purpose of the valuation of equity capital, whether it is for sale of shares by a person to another one, or if there is a merger happening of two companies, merger of two or more companies, or the absorption of the company by another, or in a capital restructuring exercise. Absorption means another company is taking this company. So whether that is happening, because then the cost of equity, valuation of equity is little more complicated, because you have to assess on that situation. And also for tax purpose, and acquisition transfer of shares in a resident company by a non-resident. So this is also foreign companies involved. One company, the resident, supposing if it is an Indian company, and another non-resident part of the involvement is there also. So if the shares are transferred, so that is also need to be understood. Ascertainment of the premium at which shares are to be issued, and normally we studied already, the shares are having a par value or face value, and if it is a good reputation, good returns providing, so maybe it is sold on the market at premium. So in order to ascertain the premium value also, we need to use that. That is also a purpose for valuing equity capital. And acquisition or transfer of shares by certain bodies corporate. So that also give a purpose to why do we need to calculate the value of equity capital. And the approaches. What are the approaches? We already studied, like there are three major kind of approaches. One is income approach and market approach and net assets value approach. So mainly we will be focusing on income approach and market approach here, and net assets value approach that we will be calculating in the capital structure, cost of capital structure studies time. So in the income approach, we have, it is also based on the discounted cash flow. Okay, the discounted cash flow, and based on that, the dividend discount model is based on the discounted cash flow. So the dividend discount model have basic dividend discount model and zero growth dividend model, constant growth dividend model, and variable growth dividend model. And then in the market approach, we have relative market comparable method, which is price earning ratio, and under which there is a trailing price earning ratio and leading price ratio, and then price to book ratio and price to sales ratio. And then market transaction method and prior sale of business method. All these things we are going to see in detail, and also some part of calculations, including some multiple choice. As dividends do not have to be paid, the return rates of common stock can vary. For example, dividends do not have to be paid, or it may be paid more or less than that of the previous year. For example, if the earning and retained earning have sufficient amount to declare dividends, as well as cash flow is available, so dividends can be maybe declared, or sometimes it need not to be paid also. So it depends on the company's dividend policy, how the company has that policy, and also the profitability and availability of funds, mainly the cash flow. So accordingly, the return rates of common stock can vary. It will not be the same return like any bond or preferred shares equity. There are three potential valuation scenario based on dividend payouts. Depends on the dividend payouts. There can be three scenarios. Either the dividends may remain fixed, that means there is no growth, zero growth rate, or the dividends may grow at a constant rate every year, like 1% increase. Okay, so every subsequent year 1% or 1.5% or 2% or 5%, something, some constant percent, the return will be increasing. Then it is called constant growth rate, or it grow at an unusual or variable rate. So that is the three scenarios that we can see the growth of the dividend also. Investors use valuation models to compare the results to existing prices to determine whether a stock is overvalued or undervalued or properly valued. All this depends on the dividends and the amount and the growth rate. Common stock valuation, we will see with an example. The future expected returns are pure estimates only in the common stock. There is usually a heavy risk premium incorporated into the calculation. Actually, there should be a risk premium that we need to incorporate. We have to be cautioned on that. Example, if a bond could be sold at its face value based on an 8% interest rate, a similar preferred stock might necessitate a 10% return because of the increased risk, because the preferred stock is slightly having increased risk than the bond. At the same time, a common stock might have more risk also, might have to be valued on an assumed return of 20%. So because it is the last in standing for the claim on the company assets, so they have more risk also. So the return also should be more, and they are the actual owners of the company. So let's say that the example we have return maybe 20%. If what for a preferred stockholders 10%, maybe double the time, it is on an average basis. It is this example is given. It is not exactly that it has to be doubled. It depends on, because investors in common stock fear the risk of ever getting future returns. A high risk premium must be used to calculate the common stock's value. So actually, the investors will prefer more returns on the, because they are more risk that they are taking on the common stock. Common stock valuation, intrinsic value of stock. Intrinsic, the term has a meaning like essential nature of something, like inherent value. The fundamental or the intrinsic value of a business or any investment asset is generally considered as the present value of all future cash flows discounted at an appropriate discount rate, because it is inherent in the stock value that the nature, that the essential fact is that the future return is more important, and the future returns present value is very much important for calculating the value. So that is why the intrinsic value of a business or any investment asset is generally considered as the present value of all future cash flows discounted at an appropriate discount rate. Future cash flows in the sense every year dividend will be received, and you keep on 4 year, 5 year and number of years that dividend will be received, and all these things we will have to use it in the present value table according to the interest rate. So we get the discounted present value and also the final return value of that. So also that will be considered to have that value. Intrinsic value is the price a rational investor is willing to pay for investment given its level of risk. So that is the intrinsic value. So accordingly, so he will calculate the inherent part of the expected income in present value table, and what will be he will be willing to pay for that investment. So, and a rational thinker. So there are three common ways to calculate intrinsic value. So like using discounted cash flow analysis or analysis based on the price earning ratio and asset based also. Based on that particular asset also we can make that estimation. So normally the formula given for intrinsic value of a share of common stock is this. So the value of share equal to the future value expected for each period, 0, 1, next period, like that. So you keep on summing up till the last day, and you use the rate of return to divide 1 plus that rate of return to be used for that in order to calculate the interest amount. So the I stand for the rate of interest or the interest rate. The dividend discount model, shortly it can be called as DDM, is a method to value common stock where the intrinsic value of the common stock is based on the discounted value or the present value of all expected future dividends. So the dividend discount model is under the income approach. These type of discounted cash flow models should take into consideration that the measure of cash flow, that is very important, the dividends and free cash flows to equity that is coming, and the expected holding period, how long that holding period can be there, whether it is indefinite period or limited period, pattern of expected dividends, whether the growth is there, whether it's zero growth or constant growth, that means stable growth, or supernormal growth, which is variable growth. So taking the basic dividend discount model for common stock valuation, the fundamental or the intrinsic value of a business or any investment asset is generally considered as the present value of all future cash flows discounted at an appropriate discount rate. So basic dividend discount model, the formula is like that. So the formula gives the intrinsic value of a share of common stock. So the value of share equal the given formula, where the D1, D2, D3 is the expected dividends per share on the common stock in period until N, period N comes. And the CAR stand for of the shares, investors required rate of return. What is the rate of return that the investor needs that? So it is his required rate of return. Accordingly, he has to calculate the value of the share. So that by using this formula, that he will get the intrinsic value of a share of common stock. The basic dividend discount model assumes that an investment buys a common stock and plans to hold it indefinitely, because common stock it is actually it is for unlimited period. Okay, unlike bond or even redeemable preferred shares. Okay, so therefore the N in the above formula can be extended till infinite period, and thus it is sometimes referred to as an infinite period valuation model. Also it can be talked about infinite period valuation model. The next one, we have zero growth dividend model. So the common stock price to be estimated, the formula will be like this: the value of that stock equal where D a constant annual dividend per share. So because there is zero growth, that means the rate of dividend will be annual. Annually it will be constant. So that is what the meaning of zero growth. So therefore D divided by the investor's required rate of return for that share. So that is how this formula comes. For example, a company pays an annual cash dividend of $5 per share at the end of each year. Analysts expect no change in the policy. That means zero growth. With the required rate of return is 12%. The value of common stock would be like you have $5 divided by 0.12, which is the required rate of return put in decimal, so that you get the value of $41.67. So this is being the value of the common stock price. The zero growth model is a special case of the constant dividend growth model called Gordon's model. So next one is constant growth dividend model. So estimated value of common stock equal to the dividend, expected dividends per share for each year. Year 1, for example, that is given and divided by the investor required rate of return minus the growth rate. So that is important. The investor's required rate is, maybe you can say, as a cost of equity. What is this cost of? So at least everybody want to have a break even. So at least they need a cost of equity. So the growth rate, if you deduct the growth rate from that, and you get the common value of common stock. So example, a company just paid a $3 dividend per share last year. Okay, analysts expect dividends to grow at a constant rate of 6% every year. So that is the growth rate. This is the growth rate. If investors expect to receive 12%, that is the expected rate of return, what is the intrinsic value of the stock? So taking the same formula, we take that. So $3, and that has to be multiplied by with the growth rate, which is 1.06, so that we get $3.18. So that amount divided by the actual growth rate for the first year, the growth of the first year, D1, the first year, will be based on what is the current $3. As per the growth rate, you take that, calculate that into 3.18, which is the first year. So accordingly, so you take to this formula. So this is here, and divide by the expected rate of return minus the growth rate. So you get $53. So this is the intrinsic value of the the constant growth dividend model calculation for that. So step 1, that you have to, because you are given the dividend paid last year. So that is very important, last year. And you are given a growth rate. That means for this year, that is, you calculate that the last year amount multiplied by 1.06, because the same plus there is 0.6 because percent, 6%. So that means it will be growth. It will be grown up to $3.18. So taking that, because the T1 value, the dividend of the first year value, this year, current year value will be 3.18 divided by the rate of return minus the growth rate. So that is the $53. So it is very clear. The model represents a single stage growth rate. That is, the growth rate is constant. So let us understand the relationship between the required rate of return and the growth rate, which is in the given example also 6%, or summarized as follows. We can see that if the difference between the expected rate of return or the cost of capital and the growth rate widens, if the gap is widens, then the stock value falls. If the difference between the cost of capital or the expected rate of return and the growth rate narrows down, coming closer, the stock value will rise. The difference between the cost of capital and the growth rate shows small changes, then there will be large changes can result in the stock's value. So that is how you can interpret the movement on this. So variable growth dividend model. This method estimates the stock price when dividends grow at a different rate, variable rate, maybe high, peak, and maybe down, like that, for 2 or more period of time. When a common stock has varying growth rates of dividends, so future dividends must be projected separately. So it has to be projected separately, otherwise it will be distorted. That figures, whatever we calculate based on certain formula, will not be very correct. So projected dividends must be discounted back to the present value using the present value interest tables. The present value of the terminal at the end of the growth period must be calculated for each period. All present values are added together. First we have to calculate for each, because it's a variable growth rate. So each year you have to calculate, you put it in a table, calculate separately and sum it up. So that is, you bring it to the present value for each year and then you sum it up. So that's how the steps are done. Example, a company J paid an annual cash dividend of $5 per share last year. Analysts expect dividends will grow at an annual rate of 20% for the next 3 years, and then level to normal growth rate of 5% only. With a required rate of return or 12%, that the expected rate of return is 12%, or cost of capital is 12%, here is how to determine the price of the common stock today. Reading carefully the example, company J paid an annual cash dividend of $5 per share last year. Analysts expect dividends will grow at annual rate of 20% for the next year. So that means this last year dividend 5 for the current year for the D1. So this $5 multiplied by 1.20, which is the growth rate. So accordingly we get for the first year the dividend is, the cash flow is $6, and for the second year the base rate is 6, and that is taking 1.20, which is the growth rate. So it becomes 7.20. So third year it becomes $8.64. That will be adjusted with the present value factor, taking the annual expected rate of return, which is 12%. So for 12%, 1 year is the present value, 2 year, and this is 3 year, we take that. On the third year, we take the share value of that stock. So by taking the formula for that calculation for the share value, on the third year, year 3, what will be the share value? So that will be the actual, the cash flow. So that is the D3, year 3 cash flow. So that is the cash flow 8.64, we got that. And that will be adjusted with the normal rate of return, the growth rate of normal growth rate of return, which is 5%, so 1.05. So taking that adjustment divided by the expected rate of return, which is 12%, minus the normal growth rate, which is 5%. So accordingly, we get $129.57 is the value on the end of the third year. So that value is here, and for that also the present value is at the third year's present value table rate. We take that. So all the present value of the income, 3 years dividend cash flow plus the final cash flow, which is 92.25, which is at the present value. So the total present value is $109.50 for the share. So this is the variable growth dividend model example, and with that, how do you find the answer? In relative market comparable valuation method, so we already knew that in this method there is price earning ratio, and which can be trailing price earning and leading price earning, and price to book ratio and price to sales ratio. So in this analysis, an analyst attempt to control, minimize differences such as size across the firms. So because he is taking and calculating, assessing the value into ratios, so it is better for comparative analysis, and computes the multiple for each comparable firm and then average them, then individual firm to be valued, the individual firm to the average. So he is taking into average value so that we get better comparable values. Evaluate any differences between the two multiplies based on characteristics of the individual firm such as growth or risk. Item under the market relative comparable valuation, so price earning ratio. So price earning ratios, again we have seen that there is a trailing PE price earning ratio and leading price earning ratio. The simple difference being, for the trailing price earning ratio, it is the last 12 months will be the point of the earning per share over previous 12 months will be the denominator under the market price per share. And whereas for the leading price earning ratio, it will be the forecasted, because it is future. So the forecasted next 12 months earning per share value will be taken. So that is how. But simply what we should understand is that we have to take the diluted earning per share given that value. Okay, example. A company reports $10 million in earnings. So the revenue is $10 million in the previous fiscal year. Okay. Now an analyst forecasts a $1 earning per share over the next 12 months. So the forecasted earning per share is $1 over the next 12 months. The company has 15 million shares actually. So 15 million shares outstanding at a market price of $15 per share. So the market price is $15 per share. So now how do we calculate the price earning ratios? Given that the formula, we have the formula trailing price earning ratio and leading price earning ratio. So we have to take the market price per share common for both, and here earning EPS over previous 12 months, and here forecasted EPS over next 12 months. Okay. So taking this example, the solution is the previous year EPS is earning per share is revenue $10 million divided by 15 million shares. So it is $0.67. Okay, so for the trailing price earning ratio, so we take the market price per share. For both cases, it is the same, is given $15 divided by 0.67, because this is the trailing price earning. So the previous year earning was 10 million, so we take that thing. But for the future, it is already forecasted $1, so we divide by $1, so we get 15 is the ratio. Price and leading price earning ratio is 15. So Now let's see the advantages of using price earning ratios. They are commonly used in the investment community. So most of the cases. So they are using. Research shows a significant relationship between price earning differences and long run average stock returns. So actually various studies provided, okay, that based on that statistics, so there is a strong relationship that this price earning difference calculations and long run average stock returns. So what are the disadvantages of using price earning ratios are, if earnings are negative, so then this ratio will be meaningless. And volatility in earnings can make the interpretation of price earning ratio difficult, because high volatility, so this earning ratio will be very difficult to interpret and explain. A management discretion that is within allowable accounting practices can distort earnings. See, management discretion in the sense they can adapt certain different policies for the purpose of valuation, for the purpose of some depreciation and all these things, even beyond the within the framework of the rules and regulations. But sometimes they may adjust it. So that is why this ratio can be distorted. So that is the point that management accountant should take care. Next item, price to book ratios. It can be called price to book value ratio. Typically, it's a positive value, even if a company reports a loss and has a negative earning per share. So PB ratio equal the market value of equity, whatever the market value of equity, divided by the book value of equity. What is the book value of equity? It is normally like a kind of accounting book value, which is coming from the balance sheet. So market price per share divided by book value per share. So that is the ratio, PB ratio. Where book value of equity equal actually common shareholders equity. So the common shareholders equity is arrived from the taking the total assets minus total liabilities, and you have to minus the preferred stock value. So because common stock, you have to deduct from the, because total assets minus total liabilities is the equity value. From the total equity, you deduct the preferred stock, so you get the common shareholders equity. So an example, given in a year end, book value of equity $14,015 and sales is, that means the revenue is $9,450. So common shares outstanding is 3,400. So price of the share on 15 May of the year, that means the market value, is $9.50. So the book value per share, which is PB ratio, is PB ratio calculation is the market value of the equity is given, that is $9.50, and book value per share is calculated taking the book value of the equity divided by number of shares. So per share book value 4.12, so you divide that, so you get 2.31 is the PB ratio. Advantages of using PB ratios are, even when EPS is negative, because it is always positive, book value is usually a positive value. A book value measure is more stable than earning per share. So it may be more useful than a price earning ratio when EPS is high, earning per share is high, or even if it is too low, or it is highly volatile, then we can use the PB ratio instead of price earning ratio. That's why, because it is more stable. Why? Because it is more stable, because the book value, book figures are not quite often changing. So that is the thing that we do there. And book value provides an appropriate measure of net asset value for firms holding largely liquid assets, that is finance, investment, insurance and banking, etc. PB ratios can be used to value a company that is expected to go out of business. If a company is going out of business, if you want to calculate that, maybe you have to use the PB ratio, book value ratios. So research shows that PB ratios help explain differences in long run average returns also. So because normally, because book values are smoothened after depreciation, it is a stream, it is in the long run, the average returns will be maintained that way. Okay, so that is the thing. Disadvantages of using PB ratios are, PB ratios ignore the value of non-physical assets. That means the goodwill, human capital, trademark values and all these things, and even human capital's reputation values uh, cannot be calculated, added to that. Because in the book value they will not be, they may not be represented. And also the PB ratios can be misleading when there are substantial differences in the size of the assets in the firms being compared. When there is two firms are compared, so you have to see if there are substantial differences in the assets, in the size of the assets also, and also in the combination of assets. Maybe more financial assets and more non-financial assets, that also can have a different play. And maybe book value will be there, but the assets are not worth enough for that. So these kind of combinations also may be there. The true investment made by shareholders can be obscured by different accounting conventions. That also one of the things, like calling from the valuation and also depreciation calculation. So it will be the true investment value cannot be ascertained. Technological change and inflation can result in substantial differences between the book and market value of assets. Price to sales ratios. It shows how much the market is willing to pay for a dollar of sales. Per dollar of sales, how much is the market is willing to pay. So how do we calculate that? The use of this ratio is based on the belief that sales are the basic component of profits. Yes, revenue is the basic component of profits. So the ratio is equal to market value of equity divided by the total of sales, total sales. So that means market price per share divided by sales per share. So example, given in a year end, book value of equity is 14,015, sales is 9,450, common shares outstanding is 3,400, price of the share on 15 May, which is the market value, is $9.5. So sales per share, first we have to take it. So sales figure is given. So we take the sales figure divided by 3,400 shares, common shares outstanding. So per share is $2.78. So if you divide by that the market value, so you get 3.42. So this is how we calculate. So the price to sales ratios, the advantages, it provides meaningful measures even for distressed firms. How it can be distressed? Because the revenue figures are more reliable than earning per share calculation. That is one thing. And even book value is not reliable also comparatively to the sales figure that we have on hand. The price to sales multipliers tend to be more stable because they are not as volatile as price earning multipliers. So, and also price to share sales ratios are useful for valuing a range of stocks from mature or cyclical industries to startup companies, because they may not have the record of earning per share values and all. So what they would have immediately is the sales figure and the market price available. So price to sales computation is easy for them, handy for them. So research shows significant relationship between difference in price to sales ratios and difference in long-term average stock returns. So that is also, there is a relationship between the differences in that. So we can take that also, because everything, company's profitability is depending on the earning, sales. Okay, and the company's value is depending on the profitability. So there is a strong relationship from the sales figure for the changes in the values also. So disadvantages of using price to sales ratios are: high sales are not necessarily indicative of operating profits measured by earnings and cash flow, because we take the total gross sales value we take it, but maybe the profit margin may be very less. So that is not the indicative of operating profits. So that is the disadvantages of taking price to sales computation. and it do not capture differences in cost structures across companies. When you are comparing with two companies price to sales ratios, so you may not know that the cost structure may not be the same. So accordingly, the profit structure may not come. Only you take the gross revenue, and which maybe a lesser revenue for a company may return a better income. So due to their profit margin, gross profit margin and all like that. Although price to sales ratios are less subject to distortion than earning per share and book value, revenue recognition practices can distort sales forecast. So also that, because this is the basic norms, rules for the accounting, that the revenue recognition policies. So you cannot just take the sales value. You need to, especially in the IFRS system, also the contract price value, that whatever you receive, you cannot take it as revenue. So that there is also some adjustment to be done. So accordingly, so it is a point of disadvantages for using price to sales ratio. So now let's look at one multiple choice question. The par value of a common stock represents the following: the estimated market value of the stock when it was issued, the liability ceiling of a shareholder when company undergoes bankruptcy proceedings, the total value of the stock that must be entered in the issuing corporation's records, or option D, a theoretical value of $100 per share of stock with any differences entered in the issuing corporation's records as discount or premium on common stock. So what is reflecting the par value of a common stock? So the estimated market value cannot be the par value. So option A is not correct. So the liability ceiling of a shareholder when a company undergoes bankruptcy proceedings. So that is sounds like the rule that we have seen earlier, because under bankruptcy proceedings, the shareholder's liability is up to the par value of the stock. So that answer B is the right one. Let's analyze C and D also. The total value of the stock that must be entered in the issuing corporation's records. So that is not the correct thing, because issuing corporation may sell the stock at premium also, or may sell the stock at discount also. So the total value of the stock that must be entered in the issuing corporation's records cannot be also true. So option D says a theoretical value of $100 per share of stock with any differences entered in the issuing corporation's records as discount or premium. So discount or premium cannot be taken for par value of the common stock represented. So option B. So we are seeing option A is incorrect, because par value is rarely the same as market value, because estimated cannot be the truth. Option B is correct, because par value represents a stock's legal capital. It is an arbitrary value assigned to stock before it is issued. Par value represents a shareholder's liability ceiling, because as long as the par value has been paid into the corporation, the shareholders obtain the benefits of limited liability up to that extent of that par value. And D are wrong, as we saw that, because all assets received for stock must be entered into a corporation's records. All assets received should be there. Okay, the amount received is very rarely the par value. It may be with the premium or discount. So therefore, that is C, and also D also cannot be the correct one. So option B is right. So now, so far we have seen with the common stock valuation, and now let's see a simple calculation for preferred stock valuation. If a company pays a fixed dividend at the end of each year, the valuation is determined using the zero dividend growth model used for common stock. So this is very clear. We had already studied while we calculated for the common stock that there is a zero growth rate model applied, the dividend based model. Okay, so why? Because preferred stock has a fixed dividend. So therefore, there is no growth. So it is a zero growth. So therefore, the calculation is very simple. So valuation of preferred stock is, so just valuation of preferred stock equal to the cash dividend per share divided by the expected rate of return, the discount rate or interest rate in the market. Okay, for the preferred stock in the market. So that is the idea. So example, par value of 7% preferred stock, $100. So we know, we calculate that the discount rate for similar preferred stock in the market rate is expected rate of return is 8%. So therefore what we do is that, so we calculate 7% preferred stock comes to $7 and divided by expected market rate of return is 8%, 0.08. So therefore the value of the preferred stock is $87.50. Even though the par value is $100, because why it is less? We can easily compare that. Earlier study also we have done that. The preferred stock giving only 7% return, whereas the market rate is 8%. So it is less than the market rates. Therefore, the value of that stock is less. Okay, so that is that. If the market discount rate goes down, the value will, if the market return rate goes down than the preferred stocks rate, so then the value will increase, and vice versa. The dividend discount model, and we have four options. Option A, B, C, D ignores capital gains, and B incorporates the after-tax value of capital gains, and C includes capital gains implicitly, and D restricts capital gains to a minimum. And let's see why answer C is the correct one. And because we should understand what is capital gain means. Capital gain means it is an increase in a capital asset's value. But dividend discount model is considering all the cash flow, incoming cash flow on that stock. So capital gain also brings that gain value as a cash flow for that, and it is an intrinsic value that it has to take all the cash flow with the present value. So that is important for that. So capital gain ignore is option A is not the right answer, and B incorporate the after tax value of capital gain also not right answer, because equity capital value is not after tax. Okay, so it is not debt interest, so it is not interest. Okay, then C is the right answer that we have seen here, and D also is not reasonable because restrict capital gains to a minimum is it's not a reasonable explanation for that. Okay, the dash is defined as the present value of all cash proceeds to the investor in the stock, whether it is a dividend payout ratio or market capitalization ratio or price earning ratio or intrinsic value. So the correct answer is option D, intrinsic value, because we have studied already the fundamental or the intrinsic value of a business or any investment asset is generally considered as the present value of all future cash flows discounted at an appropriate discount rate. So here question also defines that. So therefore option D is the correct thing, all other things are meaningless. Intrinsic value is the price a rational investor is willing to pay for investment given its level of risk. Okay, next MCQ. If the intrinsic value of a stock is greater than its market value, which of the following is a reasonable conclusion? So whether the stock has a low level of risk, or the stock offers a high dividend payout ratio, or the market is undervaluing the stock, or the market is overvaluing the stock. The market is undervaluing the stock. Why? Because it is very simple. The intrinsic value, the expected value of the stock, the inherent value of the stock is greater than the market value. So the market is not perceiving that stock value because they are undervaluing the stock. So this is very simple conclusion that Okay, next MCQ. A company will pay $4 dividend next year on its common stock, which is currently selling at $100 per share. What is the market record rate of return on this investment if the dividend is expected to grow at 5% forever, like constant rate? So let us. So the expected rate of return is given by the dividend the next year, whatever, and the price of the common stock, the selling price of the common stock, plus the growth rate. So that is the formula for that. So we apply that. So the company will pay $4 dividend for this $100 share value next year. So that is the plus you add the growth rate. So you get 4% for this calculation plus this growth rate 5%. So you get 9% is the answer. Thank you. Thank you very much. Praise be to God. And we will continue in the next lecture covering the cost of capital for both common stock as well as preferred share.